Welcome to Yahoo Finance Live. I'm Shauna Smith along with Jared Blickery. Now let's get you up to speed on today's market action. Stocks giving back earlier gains. All three of the major averages in the red as hopes for that year-end rally continue to fade. Energy, the worst performer as we head into the final hour of trading. And investors digesting the latest data on housing. Pending home sales declining 4% to the second lowest reading on record. Threat of a recession. Also higher rates keeping buyers on the sidelines, Jared.
Yeah, and let's take a look at the markets overall. This is, by the way, the third day of the Santa Claus rally. So I'm going to show you some three-day charts of the Dow, which is down today by about 0.2%, basically break even over the last 3 days. Here's the Nasdaq. It's down 1% today, or 2% plus over the last 3 days. And the S&P 500 down just marginally, just a little bit more than 0.5%. But usually what happens this time of year is nothing really matters. You have a market melt up, you have some kind of drift, and headlines don't seem to matter as much. But what's happening this year is all the fringe sectors, all those sectors that got beaten down the most this year, those are getting hammered yet again. So we can see today energy is on the downside, down over 1.5%, followed by communication services and tech, all of those down more than 1%. And a lot of that action is not only in the mega caps. Let's take a look at those first. But you can see lots and lots of red here. I guess a couple standouts. We got Tesla. Finally, that's up about 2%, stopping, what is that, a 7 or 8 day slide here? Got to keep tabs on that. But just checking in on some of the market leaders, lots of red, and the dark red down there stands out as well. KWEB, we got to take a look at these Chinese internet stocks because those have taken a major drubbing. However, over the last month, those are some of the names that have gotten a lot of love. So back with my analysis on what got hammered this year is getting hammered even more. Just take a look at what's happened with the meme stocks. This is today. Here's the last 5 days. Coinbase down 7%. Rocket Companies down 12%. We have AMC down as well. GameStop, some of those OG names. But my point is, Shauna, the fringe markets here are seeing no investor love, and this is antithetical to what we see this time of year usually. So all of this portends, if we don't get that Santa Claus rally, that portends a negative setup for the following year. Doesn't mean it has to come true, but usually this time of year, we're just sipping our coffee and reading the paper.
I know investors really holding out hope. Maybe the final hour trading today and the final 2 trading days of the year, maybe we'll see some of that momentum turn just to be a little bit optimistic here in the final trading week of the year. All right, we also want to get you up to speed on China. Chinese stocks falling today on worry over rising COVID cases and the impact that it's going to have on the country's economic recovery. New data out showing confidence in the job market and also income prospects, both falling to fresh lows. That is weighing on investor sentiment. You're looking at the Nasdaq Golden Dragon China Index off nearly 4% on the day. Let's break all of this down, what it means for investors as we look ahead to 2023. For that, we want to bring Kevin Mon, Hennian & Walsh Chief Investment Officer. Kevin, it's great to see you. So certainly another down day for the U.S. markets here. Of course, also the selling that we're seeing overseas in China. But let's talk about what's going on here, because I think a lot of hope heading into this final week of trading was that we were going to see a bit of a momentum shift and we were going to see some buying come back in. That's certainly not materialized just yet. What's your takeaway from the action that we have been seeing?
I believe that what we continue to see, Shauna, is tax loss selling coming off of a historically difficult year for both stock and bond investors. And we keep talking about the hopes for a Santa Claus rally. And I think in all likelihood, Shauna, this year, Santa Claus came early. As I've been speaking for some time about 2 potential tailwinds that could lift stocks higher by the end of the year. And both came to fruition. The first being the outcome of the midterm elections with a divided government. Historically, that bodes well for the stock market. And the second, of course, being the Federal Reserve shifting and scaling back the increments of their Fed rate hikes, which they did in December with a rate hike of just 50 basis points. We saw rallies after both of those outcomes, and I don't think there's any more rallies left this year for investors to look forward to.
Well, Kevin, let's think about next year and the potential for a recessionary environment. Goldman Sachs, notably not in the recession camp. They think it's going to be a soft landing, but they are in the minority here. What's your view? And if you are in the recession camp, how should investors be preparing for this?
Great question, Jared. And I would just remind everybody that the first 2 quarters of 2022, we met the technical definition of a recession with 2 consecutive quarters of negative real GDP growth. It's hard to imagine the first 2 quarters of 2023 being anything but trying for the U.S. economy following 425 basis points of hikes by the Federal Reserve in 2022. Their suggested terminal rate is 5%. So that means 3 more potential 25 basis point hikes in 2023, of which I think they'll do in the first half of the year. Then they'll pause, step back, and take a look at all the damage that they've done to the U.S. economy at that point in time, similar to what we've seen in the U.S. housing market. You noted it before. Pending home sales now registered their second biggest loss on record going back to 2001. That's going to trickle through into the economy because the consumer who continues to dip into savings, who continues to put more in their credit cards, is going to have a tough time keeping up with inflated prices in the new year.
So, Kevin, what does all this mean just from a strategy perspective? Investors that they are looking to put money to work, what are some of the things that they should be considering then in the new year?
Right. And I don't want to sound overly pessimistic because my theme for 2023, believe it or not, is better days ahead, as I believe that there are better days ahead for investors, particularly in the second half of the year. But the first half of the year is going to be a difficult one with respect to economic growth. A lot of uncertainty about how far the Fed goes, how aggressive they're going to be. So investors may want to position themselves in the early part of the year more defensively in those sectors that have historically done well during economic slowdowns up to and through recessionary periods, such as healthcare, utilities, consumer staples, and then industrials. But once the Fed does stop this rate hike cycle, once we see inflationary pressures coming more under control, then look to those beaten up sectors, the technology, the e-commerce areas, and even some of the smaller cap biotechs to rebound the most during the second half of the year because they've been beaten up the most this year.
Yeah, Kevin, I've been thinking about that a lot, and I'm actually writing about it for Yahoo Finance's morning brief tomorrow. Just thinking about the Fed pivot. It's going to come, but how long is it going to last? Is the Fed likely to have whipped inflation at some point in the near future, or do we return? Does inflation be a persistent threat for years? And if that's the case, how does this change the investing landscape? Because investors have been conditioned not only over the last 10 years, but more likely over the last 20 years. We haven't really seen a sustained period of value and cyclical outperformance over growth. It's mainly been about low interest rates. So if this is part of a longer shift in paradigm, how does this play out in the investing world? How do people prepare for this?
I believe what's going to take place in 2023, once again, is that the Fed raises another 75 basis points to get to that terminal rate of 5, and then they pause, stop, whatever term we want to put on that to see the amount of damage they've done to the labor market, to consumer spending, and towards GDP growth. Then in all likelihood, they're going to keep rates at those elevated levels at least through the end of 2023. Perhaps, Jared, considering a cut at the beginning stages of 2024. So if rates are going to be higher for longer, if inflation's likely going to be with us for longer than some earlier anticipated, you should position your portfolios accordingly. And in those types of environment, look for those areas of the market that have historically done well when rates have been higher. We mentioned utilities before. A lot of people tend to stay away from utilities when rates are high. But historically, actually, utilities perform well in rising rate environments and also during periods of extreme stock market volatility. So perhaps that's an area to consider. Preferred securities, generally issued by banks or companies from the financial sector, are worthy of consideration in that environment as well. And municipal bonds, given the supply-demand imbalance that's likely to go over into the new year, certainly seem worthy to consideration for us as well, at least as it relates to income-oriented investors.
So, Kevin, then given your theme for 2023, better days ahead, I like it. It's optimistic. Is it safe to say then that the worst of it in terms of some of the sell-offs that we've seen, is that behind us at this point? And then also on top of that, just in terms of the volatility, is that something that's here to stay, though, for the new year?
Right. So, Sean, when I say better days are ahead, I don't want people to suggest that I'm implying that inflation is behind us, because it most certainly not. I'm not implying that the Fed's going to stop raising rates, at least over the short term, because they're not. And I'm certainly not implying or suggesting that these short-term bouts of volatility behind us, because they're not. In 2022, consider this, Sean, 1 out of every 3 trading days involved a move of the S&P 500 by 1.5% or more, either up or down. That's 33% of the time. That's a significant amount of volatility. I do believe that the worst is behind us with respect to that type of whipsaw volatility, with respect to peak inflation, and with respect to peak hawkishness. So if you agree with me that those worst days are behind us, well, then clearly better days must be ahead. But how do you manage your portfolio's positioning for those better days ahead, but still allowing for some downside protection to get over these chops in the road that are likely along the way?
Any way you slice it, it seems like a very different investing landscape in the coming year. Great stuff here, Kevin. Great to see you, Kevin Mon.
Thank you.
We are just getting started here on Yahoo Finance Live. Coming up, Southwest canceling even more flights today. We're going to discuss what it means for the airline stock. And Tesla is on pace for its worst year ever. When will the pain for Tesla investors end? And a former U.S. Senator tells us what to expect when a divided Congress gets to work next month. Don't go anywhere.
They need to take care of their passengers and they need to take care of their employees. Look, everybody understands that there is extreme weather across the country, but where most airlines saw their performance start to improve, Southwest has actually moved in the other direction. We all understand that you can't control the weather. This has clearly crossed the line from what's an uncontrollable weather situation to something that is the airline's direct responsibility.
That was U.S. Secretary of Transportation Pete Buttigieg calling for Southwest Airlines to be held accountable. Now, Southwest has canceled over 13,000 flights since December 22nd. That's according to FlightAware. The airline is responsible for over 60% of all flight cancellations, both yesterday and today. So let's talk about what this means for the business. For that, we want to bring in Scott Forbes, Jefferies Airlines Equity Research. Scott, it's great to see you. So I think the big question here for investors, at least, is how big of a hit this is going to be to Southwest's revenue and to its profit in the fourth quarter. What are your expectations?
Yeah, so our assumptions right now are that these cancellations are expected to span around 60% of flights between December 22nd and December 31st. In aggregate, that's around a 6% capacity hit. And when you actually bring that over to the revenue side, it's going to be around 9% of their Q4 revenue as a full impact. And then on the cost side, just from the inefficiencies surrounding all of these flight cancellations, the lower capacity and all of those items, you're going to look at a 10-point unit cost hit. And in aggregate, we expect there to be a 700 million EBITDA hit to the bottom line, which is almost 60% of our Q4 expectations of 1.1 billion of profits. So it's almost a 60% hit on their Q4 profits of what really is just one of the worst weeks that we've seen in 20 years for an airline.
And Scott, how much of this hit that Southwest stock is expected to take, or at least their financial statement is expected to take, coming from the need to modernize their operations and the need to upgrade their technology? It seems maybe a simple bug fix is out of the question, or maybe not out of the question here, but it seems there are some antiquated systems that need to be brought up to snuff. So just wondering if that's part of your analysis here.
Yeah, it's not necessarily in this quarter, but I think as we look out over a 3-year period, I mean, that's definitely something that has to be kind of taken into account. Southwest has sort of faced a headwind over the last few years where they haven't necessarily invested into their systems. They haven't necessarily invested into their product. And those decade or so of underinvestment is going to hit them over the next 3 to 5 years. So whether that be 2 billion of investments into the product and the actual plane and bringing USB-C ports onto the plane, upgrading the Wi-Fi, adding larger overhead bins, like all of that just adds to this incremental investment that they're going to have to make into these systems that are clearly very problematic for the airline and will be very expensive to fix, both in this quarter, but also over the next few years, kind of investing in these systems and getting their operations up to what's expected for the industry.
And Scott, we heard that from Southwest CEO Bob Jordan. He was responding to some of the backlash to these cancellations. I want to play a quick soundbite for what he had to say.
The tools we use to recover from disruption serve us well 99% of the time, but clearly we need to double down on our already existing plans to upgrade systems for these extreme circumstances so that we never again face what's happening right now.
So Scott, Southwest CEO, clearly seeing the need for investment. But my question to you is just the reputational damage from this in terms of future demand, what that potentially looks like for Southwest. I guess, how long do you see this backlash really affecting the airline?
I mean, it's substantial, and it's something that could really affect customer demand for the next year. I mean, Southwest was out over the past year talking about extending flight credits and how much goodwill that was really giving to them across the airline. Instead, now you're facing a reputational damage that's coming from one of the worst airline incidents over the last 20 years. So it's substantial, and it's something that will likely affect profitability and demand over the next 1 to 2 years, if that.
And Scott, Southwest is known for its fleet of 737s, and according to your notes, they're going to take delivery of 312 aircraft between 2023 and 2025. How does this affect their operations?
Yeah, so that'll actually be fairly positive for the operations. It'll allow them to move to the MAX, which is 20% more fuel efficient per seat, offers more seats per plane. So there's substantial benefit coming from that and the cost benefits that come with that as well. The issue is that those 312 aircraft, you're going to spend incremental CapEx on them throughout the next 3 years. So those 312 aircraft, you're looking at 14 billion of CapEx. The airline's going to be a cash user over the next 3 years of roughly 600 million to $1 billion, in that range. So that's something that's going to affect their balance sheet going forward. And I mean, compared to the rest of the industry, it's fairly modest. But I think that's something where you're financing all of these planes with higher interest rates, and it's something that should be a headwind for the industry as a whole going forward.
And Scott, as we wrap this up here, just the meltdown that this has caused, obviously it has triggered some questions, a lot of, I guess, questions is the best way to put it, from policymakers, Biden administration criticizing what Southwest has done over the last several days. When you take a look at the regulatory risk or maybe government involvement down the road, how does that look? How are you looking at that just from an analyst perspective and what that overhang could mean, not only for Southwest, but the entire industry?
I think when any specific airline gets the eye of the regulators, it's never necessarily a good thing, and it's normally for the wrong reasons. I mean, it's not something that we necessarily bake into our forecasts, but it's it's something that'll likely accelerate a lot of these investments that are being made, and these 3-year cycles of investing in crew scheduling, investing in operational integrity, investing in labor, investing in all of these items that make the operation get to where they want it to be. So that's the major item, and that'll be a headwind to profitability over the next 3 years.
Scott Forbes, great to have you. Thanks so much for breaking down the risk here for Southwest going forward. All right, well, coming up next here on Yahoo Finance, Amazon reportedly planning a sports streaming app. We'll have the latest on that. We've got a guest coming up saying that 2023 will be the great housing bust that never happens. He'll explain when we come back. Amazon could be taking a step further in the sports streaming landscape. There's a new report out from The Information saying that the tech giant is planning a standalone sports streaming app. Now, this app would feature Amazon's key sports offerings, which include its NFL Thursday Night Football package, also Premier League soccer matches. Yahoo Finance's Josh Schaefer here on set to discuss this. And Josh, this is an interesting report from The Information. We don't really have any more information when it comes to the potential cost of this, the timing of this. We know CEO Andy Jassy has said that sports obviously is a priority or present really a unique opportunity here for the company going forward. If they do launch this, I think there's lots of questions just about cost and why it wouldn't be folded into what it currently has with Prime.
Right. It's not surprising to see Amazon wants to do more with sports, right? Like you said, we sort of knew that was coming based on Andy Jassy's comments, and they're paying $1 billion for that NFL package. They're going to want to get a little bit more out of it. What is shocking here would be if it's separate from the app. A lot of what we've heard, I know Laura Martin from Needham stresses to us multiple times from analysts, is basically the point of the NFL streaming package is to bring non-Amazon users into the Amazon ecosystem. If you separate the NFL users from that by just giving them a separate app, I don't know if you're getting that benefit. I'm not then going to go on the Amazon Prime Video app and get attracted to Lord of the Rings or some other streaming offering that's on Amazon. So I think that that's kind of an interesting part that sticks out to me here, Jared, would be, does separating it really help Amazon, or does it just sort of make it a little bit of a, I don't know, I guess different than what they were going for.
Well, let's take the history of Amazon here. I'll give you a good example. Remember the Whole Foods purchase? I think that was announced in 2016, 2017, and it just kind of rocked Wall Street because everybody was thinking, wow, does Jeff Bezos really want to get into food here in a big way? Because Jeff Bezos is famous for talking about failing at scale here. He wants to get big and try something out, not just kind of dabble. So if this is a bigger move into sports, what's the ultimate destination? I don't know. How big could we be thinking here?
Yeah, no, I think that's a good point, Jared, is too, Amazon is starting to build out something where they could have more of a sports offering, though, right? Their show that they have on top of Thursday Night Football right now is pretty good. They have Andrew Whitworth, Richard Sherman, Ryan Fitzpatrick. They have guys that play in the NFL that is pretty good. Are they going to go to a sports platform where they just have a talk show? Is it on in the middle of the day, and do they have more offerings that way? I think could be interesting. It's certainly not the only thing we've seen, not the only sports streaming app we've seen, right? CBS does this, NBC does this. You can get an NBC sports app on your TV outside of Peacock.
Yeah, and I think the big question here are just exactly the plans, what this could potentially signal in terms of if Amazon wants to make any other sort of strategic acquisitions when it comes to sports content right now, what is already being out there. There's been certainly a number of rumors or what could be for sale, what certain companies could be spinning off. But I think also the question is just the appetite for this and whether or not people are going to be willing to pay for another streaming service if they already have Prime, if they want to pay for something separate, and then of course, the cost of it. But I think it does kind of diversify Amazon's revenue stream. It creates another revenue stream for them specifically focused on sports. We know that Thursday Night Football package costs a lot of money for the company. So we'll see whether or not this all pays off. I don't know. Could signal something big. That's all I'm saying.
Yes, I agree. Josh Schaefer, thanks for stopping by. U.S. pending home sales fell in November, with contract signings declining in all 4 major regions, according to the latest data from National Association of Realtors. But with mortgage rates falling throughout December, is a housing market rebound coming in the new year? We're joined by Citus AMC Managing Director and former Fannie Mae executive, Tim Rood, to discuss. Tim, thank you for joining us here today. Your overall assessment of the U.S. housing market, it's been depressed this year. What's the outlook for the new year?
Yeah, well, good to see you all, and Happy New Year. So 2022, I think we often forget, came in like a lion king. I mean, we were crushing it on every level in terms of existing home sales, record low interest rates, record low originations, even near record for the last cycle, at least, existing new home construction. So, I mean, everything that we talk about, when you start hearing things that say are down, below, that's off of a trend that was incredibly high. So I think it's important that as we hear like, oh my God, month over month, so-and-so is down or that's down, it's really down just in terms of its trajectory. You're still going to end the year, both from an existing home standpoint and from a new home standpoint, fairly strong in the sense that you still had home price appreciation in both categories. The volume of each is down 30-odd% for existing homes. And then for new homes, it's down around 15 or 20%. But to your question, that leads to that flywheel going into 2023. What you're seeing now, the best leading indicator that we have is that mortgage originations for purchasing a house are down about 40% for the year, right? So we're ending at a low point, 40% lower than it was last year. You kick that into what would be pending home sales, which is the next leading indicator. It's down about 35%. So you can see you're heading into 2023 softer, and it's really up to Jerome Powell, I would say, in large part right now. How's his hand? Is he feeling lucky? Are we feeling lucky? Because he's gambling with at least 20% of the population's capital right now.
So, Tim, 2023, lots of debate out there about whether or not it's going to be the great housing bust, how significantly the market is going to weaken. Is it safe to say that that won't happen? And then I guess going off of that, if it doesn't happen, in terms of the drop that we could see in home values, what does that more specifically look like heading into the new year?
It's a great question. Look, it's something everyone's trying to figure out. And I think the easy way to look at it is probably following the track of interest rates. If interest rates continue to start going back up towards, say, 7%, right now they're at 6.5%. Seems to be that if they get closer to 7, that's when things really start to break down. As interest rates got back to the lower 6s, you saw far more buyer enthusiasm and energy. So if interest rates go up, this is that one track, you're going to ultimately see prices soften. and you're going to see the amount of inventory increase because there'll be fewer transactions. I don't take softening as a 15 to 20% collapse for a number of reasons we can go into later if you have time. But the other trajectory, which is really where places like Fannie Mae, Freddie Mac, the National Association of Realtors, people who are really in the know are saying, hey, look, we're seeing a trajectory that looks closer to 6%, 5.5% interest rates. If that were to happen, then you're going to have far lower amount of inventory because you're going to have more sales happening, and you're going to have property values are going to see much more sticky, and in some places of the country, particularly on the east, probably go up in 2023.
And when it comes to the supply of new home sales, where are we? Because it looks like there might have been a bit of overbuilding, but I think we're still at historically lower levels, at least in terms of the historical range. Can you update us on that?
Yeah, the problem is that it's certainly gone lower. Look, builders learned a lesson in the 1980s. They learned them in the mid-2000s that when they get over their skis and they overbuild basically for anticipated demand, and then whatever the exogenous event is, the black swan event, they found themselves overcommitted with too much production, too much unfinished production, too much inventory, and quite frankly, a fair number of them ultimately go out of business. This time, however, as soon as they started seeing interest rates go up and demand go down, they pulled back. You saw permits drop by 70% this year, by the end of this year. So they pulled back. They're like, guys, let's just get rid of the stuff that we've got in the pipeline. Finish building it. Let's get out of this, put our hands in our pocket and see what 2023 has to bear. So don't expect the builders to bail us out of this predicament, I think, in 2023. All
right. We got to leave it there, but great information there. Tim Rood, thank you. Coming up, Apple shares hitting an 18-month low. We're going to tell you what's weighing on the stock when we get back.
Time for our triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Generac, Apple, and Tesla. Let's kick it off with Generac is leading the S&P higher at least today after Janney initiated coverage on the stock with a buy rating, $160 price target. We're looking at gains of nearly 6%. Now, analyst Sean Milligan saying that the current valuation is attractive following this year's massive drop that we've seen in the stock. You can see it now trading below $100 a share. In a note to clients this morning, he wrote that, quote, despite near-term headwinds, the core business exhibits secular growth trends, and also that the company has a roadmap to deliver a complete suite of residential solar and storage products to the market. Shares moving to the upside today. Jared, it has certainly been a rough year to say the least for Generac, one of the worst performers in the S&P. So I guess at current valuations, Janney's seeing a buying opportunity for investors.
Sure. If you look at it that way, I'm looking at the Wi-Fi Interactive. This is a year-to-date chart. We were just kind of looking at this, but I want to switch over. So down 72% might as well be one of those high-flying pandemic darlings, which in fact it is. Generators, people thought they're going to need a lot of them, maybe overbuilt in terms of capacity here, but basically flat over the last 3 years, down about 80% from these highs there. And you take a look at a max chart, basically back to baseline levels here. So just another story, kind of emblematic of what's happened here. Now, my triple play here is the most important bellwether stock on earth, Apple. And let's take a look at the price action here. I'm going to put a year to date. Guess what, guys? Bad news. It is hitting 52-week lows as we speak, down about 29%. Now, this is the fourth straight day, and it's also the lowest price since June of 2021. Industry watcher TrendForce, this is the reason here, slashing its estimate for 2022 iPhone 14 production is 78.1 million units, with 47 million units slated for the first quarter of 2023. All in all, Bloomberg Intelligence estimates the 2022 shortfall for the iPhone 14 Pro models, that's where they make most of those in Foxconn over in China, that'll be 6 million units, so a 6 million unit deficit. That's as a surge in COVID infections, still wreaking havoc on staffing at its main Foxconn manufacturing facility. And to mitigate the damage, Apple is moving production of key components to India, Vietnam, and other areas. So not the best looking chart here, especially when you consider the importance of it. But I'll kick it over to you, Praz, for any comments.
Yeah, you know, it's funny. We were talking to a guy yesterday from China Beige Book about supply chains in China and how companies might move that over to India's and Vietnam's of the world because of the fact that you're struggling to make your products there. And for Apple, it's not that they can't sell these iPhone 14 Pros, iPhone 14 Pros. They actually can't make enough, right, because of these COVID breakdowns. So, you know, actually, I'm watching a stock here that's also being affected by China. It's Tesla. The stock poised, though, to snap a 7-day losing streak, but it's a brief respite for investors who have seen it fall 17% over the past 5 days and a whopping 42% over the past month. Some technicians are even eyeing the $100 level as support. That's Jonathan Krinsky, our buddy, which was unthinkable only a few months ago, $100 level.
Maybe a few weeks ago. To be quite honest.
I know. China concerns, again, weighing on the stock recently. We'll see. We'll get those. But we'll also get Q4 delivery numbers next week and the new IRA tax credit going into effect next year. So maybe the Tesla bulls will have something to look forward to next year. But the big picture right now is short-term pain right now as we end 2022.
Yeah, certainly a lot of pain investors have been feeling, Tesla investors, over the last several months. Questions about demand. We'll be talking to Colin Rush from Oppenheimer in the next hour about his outlook for Tesla and reasons to still be optimistic on the stock. Yes, Jared, we do have this overhang from Twitter, the distraction that has certainly been for the company over the last several months. I think the question here going forward, in addition to the demand side of the equation, is how long it's going to be until some of that distraction starts to mitigate just a bit at least, or maybe Elon Musk won't be as vocal on Twitter, so we won't see that backlash anymore. I don't know.
There's an old saying, don't catch a falling knife. This knife is so big and it's falling so fast, I'm tempted to catch it, but you got to wait for a little bit of strength there. Just want to show you real quick on the Wi-Fi Interactive. This is a month-to-date heat map of our mega caps at the very bottom. Tesla, the worst performer, down 43% this month over the quarter. And Shauna, this is something that I think you've been honing in on as well. Look at that. Tesla right at the bottom, down 58%. Year to date, guess who's at the very bottom there? Tesla down 68.5%, Shauna.
Certainly been a rough year. We will see whether or not Tesla kind of shifts the momentum, turn things around in 2023. All right, coming up next, our next guest saying that China's reopening presents a generational opportunity for investors. Stay tuned to hear why when we come back.
The U.S. will reportedly now be requiring airline passengers from China to show a negative COVID-19 test before flying. Now, passengers will still be required to take the test 2 days before their departure to the U.S. Earlier, Italy announced it was going to start testing all passengers on flights from China, and that came after officials in Milan, get this, said nearly half the passengers on 2 planes from China tested positive for COVID. Concerns stem from the surge of COVID cases in China as the country starts to ease its stringent pandemic measures. And there's a lot of hope that China's reopening will spur the country's economy a bit, but is hope a strategy? One way investors are going to try to cash in on that reopening is through ETFs. More and more, we're joined by Vetify Vice Chair Tom Lydon for this week's ETF report, brought to you by Invesco QQQ. Tom, great to see you here. Let's get the skinny on this. We've seen China kind of be its own animal, its own asset class this year almost. It bottomed before lots of other asset classes did this year, and it's actually outperforming over the last few months. Just wondering how you see the setup for the new year.
Oh, you're right, Jared. It's been brutal for China. That the COVID policy that they had, the zero COVID policy, did not help their economy, didn't help the markets at all over there. Many markets in China were down over 80%, specifically K-Web, which is the one that most people talk about, hit a 80% down mark just a couple months ago. But since that point, in the last couple of months, it's been up over 70%. So a lot of people are thinking there's a rebound, but not only that, you talk about generational opportunities. When you look at companies that have been spending a lot of time in China, you've got a lot of stocks that have PE ratios in the single digits, something that we haven't seen in decades. And listen, China's not going to go away. There's been a lot of saber rattling politically and also from a trade standpoint, but Xi is not going to disconnect from capital markets. And if you want to get some of that rebound, there's some great ETFs to consider.
Yeah, Tom, I think the question here for investors at this point heading into the new year is how long it's going to take in order for that economic recovery to materialize, because we're seeing that case count looks at least going higher every single day in China, how much that's going to hold this economic recovery back. So if you are willing to take that risk and allocate some of your holdings to China, what should be the screening process just in terms of when you're trying to identify some of the winners and the losers when it comes to ETFs?
Yeah, Shauna, it's a great point. And listen, it doesn't mean that we can't hit lower lows from this point. China economy is in tough shape. However, I think the big word for 2023 is diversification. We in the U.S. tend to have a home country bias. We've got way more allocated to U.S. companies, and that's really worked well since we came out of the financial crisis. However, if you look at volatility, you look at value, you look at the prices that you can get in stocks overseas these days, it's really quite incredible. And if you've got some staying power, 5 to 10 years, which most of us have, it's worth diversifying into those areas. I think we look back a couple decades ago when China was the place to invest and a lot of people made a lot of money. We never thought we'd see those opportunities again, but here they are in front of us. So we know historically when it doesn't feel good in your stomach, usually there means there's opportunities ahead.
Well, Tom, wanted to get your thoughts on emerging markets in general, because if I go to an emerging markets ETF like EEM is one, that's going to be disproportionately representing China. Just wondering, would you say investing in a specifically Chinese ETF such as K-Web, the Crane Shares Internet ETF from China, is that better or worse than investing in something like a more general emerging markets product?
Just by the sheer amount of companies in the market capitalization in emerging markets, China's just going to dominate. So yes, there are some great ETFs like EEM, but because they're measured, their indexes are measured on market capitalization, you're going to see more. However, if you want to get into some other ETFs that are more diversified, equal weight by countries, there's some opportunities there too. Or you can go to single countries. One of the best performing ETFs this year was the iShares Turkey ETF, up 93%, ticker TUR. So take a look at that. One other thing to consider, folks, is currency had a big play in the underperformance of emerging markets this year. The dollar was really strong, so it not only was affected by the price of the stocks within those countries, but when you had to convert them to the US dollar, when the dollar was on fire, you paid for that as well. We may see the reversal in the dollar when markets start to settle, especially when the Fed finally finishes fighting against inflation. So that's another thing to look out, because currencies today really are an asset class.
And Tom, when it comes to, there certainly has been an investor appetite here for ETFs, and you can see that by the fund flows. That they're expected to exceed $630 billion for the year from the numbers that you sent over, the second best year on record. When we talk about what's accelerating this move into ETFs and what you think that's going to look like heading into 2023, are you expecting another year that's going to be this strong?
Well, it definitely is the investment vehicle of choice. And unfortunately for the mutual fund industry, the tax efficiencies of ETFs and the fact that you're not getting year-end capital gains distributions in a year where you think about, for the first time in 40 years, where we've seen both bond market mutual funds, stock market mutual funds declining, many are kicking off big capital gains because in order to raise money to meet these redemptions, they're having to sell low-cost basis stock. So it's kind of adding insult to injury. So you're seeing more money starting to shift over to ETFs that tend not to at all have capital gains distributions. That's something to think about. And again, Sean, I would say this: if we ever see more ETF proliferation within 401k plans, it's really going to be doomsday for the mutual fund industry, because in most cases, that's where most of the new money is going into mutual funds via 401k plans.
Certainly something to keep an eye on. Tom Lydon, always great to have you. Thanks so much for joining us here this afternoon.
Happy New Year, folks.
Thanks, you too, Tom. Well, coming up next, we will explain how tax loss harvesting can help you save money in a down market year. We've got the details for you when we come back. After 3 straight years of gains for the S&P, the index is on track to fall about 20% this year. But there is a way for investors to use some of those losses to their advantage on their tax returns. Our own Josh Schaefer has the breakdown for us. Hey, Josh.
Yeah, Shauna, so after several positive years leading into this bear market, it's likely some investors sold some gains to brace for the market downfall, and they'll have to pay taxes on those gains come tax season in the spring. But if they also lost money in the market this year too, they can sell those stocks before 4 p.m. on December 30th and offset those gains. This concept is known as tax loss swapping or harvesting, and we're going to take a look at how it works here. So say an investor realizes $10,000 in stock gains this year, but that same investor also lost $13,000 in capital losses. In those positions. So then the investor can write off the capital gains. So you write off the $13,000 and it covers your $10,000. You therefore pay $0 in capital gains for 2022. But there's still that $3,000 left. And guess what? You don't have to waste it. So the investor can take that $3,000 and either apply it to their annual taxable income or they can save it. Now that $3,000 is the cap, so it's the most you can use for taxable income. But you can harvest it and save it for future years, guys. And that can come indefinitely. So you can use it in 5 years, you can use it in 10 years. That $3,000 stays and can cover future gains.
All right. Well, let me put it to you this way, Josh. What else should investors look for when considering this move?
Yeah, Jared, really the key here is going to be this 30 days. So you cannot rebuy one of those stocks within 30 days. So if you sell a stock, say you sell Apple stock today, you can't buy Apple stock for the next 30 days. Otherwise, your coverage of those capital gains is nullified and you have to pay that tax. So that's something to watch not only for yourself and what you do with your own retail portfolio, but say you also own a mutual fund and you don't know what that fund manager is buying, that's something investors need to be careful of, because if that fund manager were to buy Apple stock, that would also nullify your gains, and then you would have to pay those capital gains come April. So could be an advantage, Jared, but something you have to always be wary of as far as what you're buying come January as well.
Yeah, I got to tell you, I've been doing a little tax loss harvesting myself this season.
Not surprised at all.
It's the season.
Yes. All right, coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live. We're minutes away from the closing bell. Let's break down the market action and look at this. The Dow, S&P 500, Nasdaq, and Russell 2000 all down by 1%, making a mockery of the Santa Claus rally. Let's take a look at the sector action. Everything in the red today. The financial sector, the least bad off, but energy really taking on the chin. That's down 2%, followed by tech, real estate, materials, communication services, and industrials. All of those sectors off 1% or more. And you take a look at the Nasdaq, all we got to do is look at the upper left. Apple down 3%, mitigated perhaps by Tesla. That's only down 3%, but guess what? Tesla, a much smaller block than Apple now. Microsoft down 1%, Alphabet down 1.5%. Looking at some of the other bigger losers here, Chinese stocks really taking on the nose today. Pinduoduo down 4.5%, JD down 4.5% as well. TAL down 15%. Those education stocks still getting hammered unbelievably. Arc Components, disruption field, not looking that great, but it is a mixed board. Twilio, some green there. DraftKings, Path, all of those up more than 1%. Mentioned Tesla before. Nice to see that snapping. What, a 7 or 8 day losing streak? But is that enough to get the bulls encouraged? We'll have to see. Travel stocks. Now, we were talking about all the delays, especially with respect to Southwest. So not surprising to see Southwest Love down 5%. Wynn Resorts over in China, double whammy there. That's down 5%. Only looks like Avis Budget Group, a little bit of Specca Green there. That's up about 1%. Taking a look at the energy sector, as I said before, that is the worst off today. Looks like Pioneer, that's down 3%. Hess off 3%. Shell, a major, down 2%. And the rest, just looking at some, the rest of the majors, looking at some minor losses here. Occidental Petroleum, that's down 3% as well. Got to take a look inside the tech sector because that has been getting hit recently. Semiconductors have really taken a hit. You don't see too much dark red here today. Qualcomm down 2%. It looks like ADI down 1%. Some of the bigger names like Taiwan Semi, that's only down 1.7%. Haven't checked crypto in a while, so kind of fitting that we're going to perhaps end with this. Not a lot of action in Bitcoin and Ether. It looks like DOT, that is down 5%. And with that, we're going to head into the second closing bell of the week. Here we are.
Another down day for the markets. All three of the major averages ending lower. The Nasdaq, you can see the worst performer of the three, off nearly 1.5%. Let's talk about what this means for the final trading days of the year and, of course, into 2023. We want to bring in Keith Fitzgerald Group Principal, and also Tim Pagliari. He's CapWealth Chief Investment Officer. Keith, let me start with you because I know you had high hopes for a strong end-of-year rally. Doesn't look like certainly that is materializing, although maybe we could see the two final trading days of the year end on an optimistic note. But what's your big takeaway from some of the selling that we've seen over the last couple of days?
Well, it's an interesting question, interesting time of year. It's highly technical. It's driven by what is effectively a global deleveraging over inflationary concerns related to the cost of capital, not necessarily inflation itself. So, as much as I would have loved to have seen a rally coming into the end of the year, this is uniquely at the hands of the world central banks, which are determined come heck or high water to raise rates when arguably they're already too tight, waited too long.
Keith, you mentioned central banks, the operative word here. What's your expectation for the Fed, especially that first meeting and then beyond? Probably going to slow the hiking pace, but at what point do we get that all coveted pivot? Does it even matter at this point?
Well, I think it's more of the latter. It doesn't matter at this point. I think they lost the narrative a long time ago. Frankly, I don't have a lot of respect for that office right now. The fact that we're supposed to suddenly believe everything they say and that they have a handle on it after such glaring evidence that they don't, and $60+ trillion that's been destroyed in the interim. So, there's not going to be a warning bell when they pivot, when they relax. My expectation is mid-year, the inevitable is going to be upon them, and they're going to have no choice because capital markets are either going to be in a full-fledged revolt or simply not paying attention.
Tim, let's get you in here. Your thoughts on what the Fed has already done so far and what it needs to do or what it should do at this point going forward.
Well, I think the operative thing at this point is how much inflation are they going to tolerate, and at what level do they have to raise rates going into the first half of next year to get it under control. So, we believe that inflation is going to be stuck somewhere in the 4 to 5% range. And if that's the case, then that would suggest that there's at least 2 to 3 50 basis point hikes going into first half of the year.
And Keith, any outspoken suggestions about what sectors, what styles, investment opportunities you're thinking about as we head into the new year?
Well, I tell you what, my colleague makes a very valid point, 2 to 3, hikes into the middle part of the year. So I think now is not the time to be a hero. It's time, if you're a golfer, to keep it on the fairway. Just keep that ball where you can see it. To me, it's companies like Lockheed Martin, it's companies like Pfizer that are going to be stable dividend producers, low beta, but lots of growth no matter what happens, recession or not. And you got to hold your nose and wade in on a day like today.
It's very tough, though, to keep the ball on the fairway. Tim, when there is so much uncertainty out there right now, what is your main message to investors going into the new year?
I'd avoid companies that are going to have to access the capital markets for the first time in 10, 15 years. Corporate bonds are starting to look attractive. So clipping a coupon at 8%, when you look at the 22-year average of Nasdaq, it's somewhere around 5. That starts looking attractive again. So the savers are going to be rewarded, the speculators are not, and we're not going to have the kind of accommodative Fed policy going into the next 5 to 10 years, I believe, that we've had in the last 5 to 10.
And Tim, your thoughts on index investing? Actually, I'm getting from your notes. I'm going to throw away the punchline right here. Index investing is not good right now. I want to get your opinion on how that settles into, or how that's framed by the larger debate between passive and active investing. How does that look in the new year?
I think it's going to be a stock picker's market. I think part of what you're seeing right now in the downdraft of, say, something like Apple is related to shifts in the index. That's part of the downdraft in Nasdaq, all the Nasdaq stocks. And so I would be very selective. We don't believe in passive investing. We're active investors, and we prefer individual securities. And I think it's time, that style of investing is going to be back in vogue again.
Keith, when it comes to earnings, that's going to be a huge focus here for investors in the new year, because certainly a number of estimates out there are calling for a recession. But when you take a look at the earnings estimates, that doesn't necessarily reflect that at this point. Do you think more downward revisions are ahead? And I guess how bad could it potentially get for some of those names?
Well, that's the multi-trillion-dollar question, right? I mean, this is why I watch your show, so you can help me figure that out. All joshing aside, we have no idea how bad it's going to get. But what we do know from history, and this is very clearly shown, is that the markets typically bottom, find a footing before the economic conditions do. So that's a presupposition that the markets are forward-looking. So when it comes to companies like Apple that are just getting shellacked right now, the question investors need to ask themselves is, does that have the power to continue to change the world? I submit the answer is yes. So, I own it, and I'm keen to buy more, especially if there's more selling ahead.
And Tim, your thoughts on the upcoming earnings season?
Well, we went into this year with some of the highest valuations I've seen in my career in an environment where interest rates were zero. And so you're going to have some compression just in the multiples as interest rates have risen. And now with the slowing of the economy, you're going to see some downward revisions in earnings. It's just a question of how much, how far have the valuations fallen, and is the earnings season going to make that worse, or are we at a kind of a stable point here?
Well, we're going to have to leave it there. But Keith Fitzgerald and Tim Pagliara, always great to see you. Coming up, Tesla stock is having its worst year ever. We're going to talk to an analyst who recently downgraded it. Up next. Welcome back. Tesla on pace for its worst year ever, with shares plummeting nearly 70% and losses accelerating the past month. Shares of the EV giant falling roughly 40% in December, including a 7-day losing streak that was snapped this afternoon. Oppenheimer's managing director and senior research analyst Colin Rush downgrading the stock to perform from overperform, and he joins us now. Great to have you here because we have a number of Tesla analysts who are saying the stock is cheap now. On valuation concerns, we're going to give this a buy. We're going to slap an outperform rating on this, or maybe we're going to up our price target. You might have a different view here.
Yeah, just so we're clear, I downgraded last Monday after the events where Twitter banned a select number of journalists. That was a bridge too far for us. So this isn't a new call for us. We've been very constructive on fundamentals, and so my peers that are talking about strong fundamentals for Tesla in the EV market, we would agree that actually Tesla has a pretty substantial lead on EV technology, whether it's batteries, powertrains, motors, designing weight out of the vehicles, as well as moving into the AI that's really driving the autonomous vehicles. So we're relatively bullish on Tesla from a vehicle perspective and a technology perspective, knowing that this year is going to be a bit of a test year for the EV industry as new models come out and we see where consumer sentiment is. But our concern with Tesla and the reason we're on the sidelines is really around the brand damage and what that means for pricing and margin for Tesla that's come out of the Twitter acquisition and some of the forays into politics and other areas from Elon Musk and how associated Elon is with the Tesla brand.
Well, Colin, what do you think it does mean in terms of pricing and margin then for Tesla?
Well, we've already seen a couple of things in the last week or so that Tesla's offering additional discounts to push some product through before year end. They typically do have a very substantial push at the end of the quarter to get as many vehicles delivered to customers before the end of the quarter. And so seeing those sort of discounts and the levers on the marketing side is really an indication that they're not supply constrained in the way that they have been. If you look back to the middle of the summer, there was still 6-8 month lead times, and those lead times have really shortened down into sub 2 months for most vehicles, or having vehicles immediately available. And so when we look at that, it's just a more challenging environment with consumers as folks look to manage their household budgets in the face of what many fear is a recession and certainly a higher cost of capital for everyone across the economy.
Yeah, Colin, and going off of that, I think demand has certainly been a huge issue here, at least for Tesla in the near term, when we talk about not only recession here in the U.S., but what that looks like on a global scale. When you couple that with the reports out of China, Tesla reducing its output at its factory in China there, I guess how big of a hit do you think this could potentially be to Tesla, at least in the first quarter of 2023?
Well, there's a couple of things going on here. So the factory in Shanghai has really been a leader in terms of efficiency. So we don't know exactly why they're dialing back some of the production here. They may be making some adjustments to the process. We could see this as a net positive, potentially. And certainly they've been exporting vehicles from China to other geographies. And so as the company ramps 2 new factories, one in Berlin and one in Austin, there's a better proximity for a bunch of the production versus where they're getting delivered. And so I think they're just rebalancing a little bit here with the factories, and certainly looking at some of the component supply issues that we've seen across the industry. Seeing them dial back some production in Shanghai for a month or so isn't a huge concern for us. What is a real concern is whether those vehicles are selling through. And if we're not seeing those vehicles sell through effectively or selling through at lower prices, then you start to wonder about margins and driving that back. We've seen the potential for this company to reach 35% gross margins on a cash-on-cash basis, and deliver north of 20% operating margins. And I think that's where the bull case sits, is looking at the company reaching north of 20% operating margins and generating an awful lot of cash. And if we start to see pricing erode, we could see some of those margins degrade as well.
Hey, Colin, getting back to the leadership question, because this is where my head is fixated right now. If the whole incident with Twitter, and there have been many incidents, but if suspending journalists gave you pause here, what does it take to get Tesla and Elon Musk back in your good graces? Or is it a Tesla that doesn't have Elon Musk as a CEO? I guess in general, what is it going to take for you to like Tesla again as an outperformer, given its current leadership quandary?
The funny thing about trust is it takes a moment to break it, and it takes a long time to build it back. And so what we need to see is some formal rules getting put into Twitter around users, seeing Elon step back and play a different role in that organization and get back to what he does at Tesla, which is really lead the idea process and where the organization is going really effectively. And so as we see that happen and we give it a little bit of time, it's something that we'll certainly consider. The other thing that we just need to be attentive to is what's going on in the broader economy. Certainly the automakers are all very concerned around what is happening in terms of vehicle ownership and new cars. We were tight on vehicles for a while. And as the supply chains have started to ease up a little bit and consumers are a little bit more, more cautious with their cash, folks are looking at that purchase and saying, maybe I can delay it a year or 6 months and aren't in such a rush to buy new vehicles. And that's something that we'll be paying attention to and is certainly part of a bullish thesis for us.
And Colin, how are you looking at the risk of ongoing share sales by Musk just in order for him to keep Twitter afloat?
It's a black box for us right now. We know that Twitter has a certain amount of debt. It's around $13 billion. We know that that's fairly affordable. What the ongoing cash needs are for the organization is totally uncertain at this point. How that gets funded is uncertain. And part of our concern with the downgrade was really that if Elon had gone out and offended so many folks in such a broad way and gave them a lot of pause, it was going to be hard for him to bring in additional outside investors. And so the cash needs of Twitter were going to fall on him. And certainly what he said in the last week or so is that he's not going to sell more shares, and that last sale was just to give him some dry powder. We just don't know the order of magnitude on that. And certainly what we've seen him do in the past is, make statements and then follow through on them to a certain extent. And sometimes there's a delay or there's sometimes some adjustments. And so just with that uncertainty, we think there's an overhang on Tesla shares, wondering about that. But right now we just really can't handicap what the real needs are.
All right, Colin Rush, always great to have you on. Oppenheimer. Tesla shares off 68% year to date. Colin, thanks so much for joining us here this afternoon. Well, coming up next, inflation didn't slow down holiday shopping, but many Americans may have taken on more debt to make their holiday dreams a reality. We've got the numbers for you when we come back. It has been a brutal year for the IPO market, with 2022 marking the slowest year on record since 2008. That's according to research from the University of Florida. And proceeds have fallen off a cliff, too, to the lowest level that we've seen in more than 30 years. Here to break it down, what exactly happened, what it signals for the new year, we want to bring in Jay Ritter, University of Florida finance professor and IPO expert. Jay, it's great to have you back here on Yahoo Finance. So the decline, the year-over-year decline, has been pretty striking here for everyone that's been following the IPO market closely. I guess, what do you make of the huge drop that we have seen in activity this year?
Day has turned to night. Last year was the biggest boom in the IPO market since 2000, and things have fallen off a cliff this year. The stock market is down, but interest rates are up. But even more importantly, the valuations on growth companies collapsed, a major reset. That affected lots of IPOs. Last year, that was one of the things driving the big activity. The high valuations a lot of the companies were able to get told them now's a great time to go public. And with this reset in valuations, lots of them said, well, we missed the window last year.
Well, I'm looking at one of your stats here. We had the lowest number of IPOs in 2022 in any year since 1979. That was another year of high inflation. That was during the Volcker Fed. We could say a lot about that. But just wondering, how much of this is because of the business cycle? And I guess the contrary, the flip side of that, do you expect once the Fed gets a handle on monetary policy, gets a handle on inflation, can we go back to the norm? What does that new norm look like?
Well, 2008 actually had fewer IPOs than this year, but actually more money was raised that year. The IPO market is not super sensitive to business cycles. For instance, in the last decade, about 30% of all of the IPOs have been biotech companies, and they're not going to have revenue for 5 or 10 years, if ever, from product sales, so that they're not very sensitive to business cycles. But the IPO market is quite sensitive to the ups and downs of the stock market, and that definitely was a major damper on the IPO market this year.
And Jay, what about the focus just from an investor perspective, or really from the big banks, just in terms of growth and profitability? That's what people are more focused on now, rather than the growth at all costs, which had been the strategy that had been working, I guess, at least from an investor's eyes over the past several years.
Yeah, last year in particular, 2021, the low interest rates led to a situation where investors were looking at growing companies that were losing money and not focusing on the short term. They were thinking about future potential profitability. But basically, investors got over-optimistic. There was just too much money chasing a lot of these companies, whether it was in public markets or especially in private markets. Venture capitalists just had so much money to throw at these companies, and that led to the escalation of valuations to unsustainable levels. It wasn't as bad as it was back in the internet bubble of 99 and 2000, but in retrospect, 2021 was approaching those levels in terms of the optimistic valuations being put on a lot of young, money-losing growth companies.
We saw this year almost the death knell of the SPAC market, that's special purpose acquisition companies. This was maybe a loophole, an area of the law where they could skirt certain requirements in terms of forward disclosures, or they were limited by the IPO market in terms of the forward disclosures they could make. And now that loophole has been closed. We haven't seen a lot of activity in SPACs, almost nothing this year. Wondering if that chapter is closed on this market or if you expect a resurgence.
Well, it's temporarily closed, but this year 101 mergers occurred where a private company did go public by merging with a SPAC, and that's the second largest number ever. Only the previous year, 2021, had seen more than that. But all of the trends are down. Way fewer SPAC IPOs went public this year. lots of the SPACs that went public the last 2 years that had not found a deal yet or not completed a merger are instead liquidating. And in fact, this month, before some tax law changes, there's a rush to liquidate. Already 80 SPACs have said, we're giving money back to investors. We're giving up on trying to find a merger partner.
All right, we got to leave it there, but did you have one more? We're going to leave it there. Thank you for that, Jay Ritter. Now, the average holiday debt, it's spiking this year, and according to a new survey from LendingTree, 35% of Americans took on holiday-related debt this season, about the same as last year. However, the average amount of debt they took on reached $1,549. That is up 24% from last year's $1,249. One interesting stat is that fewer people were using buy now, pay later this year, though it is still the second most common source of debt behind credit cards. And Shauna, this is interesting here. I got to say, I'm a little bit proud of myself because I haven't gone into debt this holiday season, but that's peculiar to my circumstance. Maybe my Christmas gifts just weren't that good this year. How about you?
Yeah, I mean, it's a little, I think it really just illustrates the times that we're in right now, how tight some of these budgets are for people, because many people that are in debt because of what they've spent on holiday spending weren't anticipating that they were going into debt. So it really just shows how small of a margin so many people are living on a week-to-week, month-to-month basis. When you take a look at some of the trends, though, what stuck out to me was that buy now, pay later explosion. That's cooling. 24% taking on debt to say that buy now, pay later was a part of it. That's actually down on a year-over-year basis. And you can see credit cards playing a bigger role in that at 59%. I think that decrease, at least in buy now, pay later, was a little bit surprising given the fact that option has been so attractive the way that it has been marketed to consumers. We saw that buy now, pay later really gain some momentum in previous years, at least last year. When you take a look at how many consumers took advantage of that, it looks like at least at this point, it's not looking as attractive, maybe because people have seen what happens with the buy now, pay later when you don't pay on time, some of those interest rates that you are faced with.
So maybe a little bit of responsibility creeping in here. I will say those credit card interest rates are out of sight. I checked, just out of morbid curiosity, I checked the interest rate on one of my cards the other day, which is something like prime plus 20%. It's approaching 30% right now, which just blows my mind, makes me want to reduce whatever little credit card debt I have. So to anybody out there who's being able to avoid that trap, my hat's off to them. All right, coming up, the crackdown on TikTok has spread to the House of Representatives. We're going to tell you all about it next.
Lawmakers in the House of Representatives will have to delete TikTok from their devices. The app has reportedly been banned from government-issued devices managed by the U.S. House of Representatives. That's according to an internal memo from the House's chief administrative officer. Now, the new rule gets ahead of a government-wide TikTok ban, which was passed last Friday as part of the $1.7 trillion spending bill. Many lawmakers have called for a ban in some capacity of TikTok in the U.S. Well, we spoke to FCC Commissioner Brendan Carr last month, and he gave us his thoughts on why TikTok should be banned. Let's take a listen.
This isn't an issue like Huawei or China Mobile or ZTE, where there's a direct regulatory role for the FCC, but I do have some experience in working in those cases having to do with companies with deep ties back into communist China, as well as malign data flows. And so I'm happy to bring that to bear here. As you pointed out, in the main, I think this is Treasury to the CFIUS process. We're looking at this. There was a rumor a couple weeks ago in the New York Times that Treasury had a preliminary deal in place with TikTok already to allow some continued data flow. The reason why I just don't see a path forward to cutting any sort of deal at this point has to do with the trust in TikTok. The whole basis for the deal with CFIUS has to do with something called Project Texas, which has to do with locating more and more data on Oracle servers here in the U.S. But there's a report just about 10 or 14 days ago that had a TikTok official in L.A. Meeting outside of business hours, off-site with another TikTok employee, asking very unusual, detailed questions about the location and other details of those Oracle servers. Similarly, there was leaked internal communications that had a TikTok official in D.C. saying that at the end of the day, once this Project Texas has stood up, it remains to be seen if product and engineering, meaning Beijing, can still get access, because at the end of the day, these are technology tools they built in China. So if TikTok officials aren't sure that a CFIUS deal can protect America's national security, then I think we should believe them.
And Commissioner, we actually asked one of our guests last week, Michael Wolf. He's the CEO and founder of Activate Consulting. He was on sharing his predictions for the tech sector at large in 2023, but we specifically asked him about a TikTok ban. I want to play what he said and then get your reaction to this.
TikTok is a disruptive force, not just in social media, but across all technology and media. Given the popularity of this, it's a huge mistake for the government to try to regulate it. What ends up happening is when you don't allow people to have a legitimate reason to access something in technology and media, they find an illicit way of doing it. So it'll be a huge mistake, and it's hard to enforce.
Commissioner, what's your reaction to that?
Well, I agree that it's immensely popular. I mean, millions and millions of kids are on this application. At the same time, it's not a direct analogy, but when we dealt with Huawei and ZTE, those were immensely popular products in the enterprise business market. But at the end of the day, we've got to move forward based on national security. And I think the tide is moving out on TikTok at this point, whether it's action through Congress, action through CFIUS. I think there's something that we have to do here. And I think that's the direction that we're largely heading. I mean, look, it is still to be determined exactly what CFIUS does. But there's other alternatives out there as well. There's other short form video applications that exist. So if people want an outlet for these highly popular dance videos, there's still a way to do that. But just we can do it in a way that this data isn't flowing directly back to Beijing, which also, again, is feeding their AI, feeding their algorithms, training them, improving them. And I think that's a threat to us as well.
Now, obviously, if you're the Play Store or you're the Apple App Store and you're wondering, what does this mean for us? How on earth do you incentivize these companies to remove TikTok from their platforms?
Well, I wish they would. I wrote a letter back in June or July to Apple and Google saying, put the national security concerns to the side. I'm not asking you to make that decision, Apple or Google, but you do have rules in place that say if there's nefarious data flows or data is being used for undisclosed purposes, we kick out apps out of the App Store. I think that's exactly what's been happening here. In fact, there's a bipartisan group in Congress, a Democrat and Republican, just sent a letter to Google and Apple within the last couple of days, making basically that an exact point that you hold these app stores out as safe places to get applications. But given the tracking and other undisclosed conduct that's happening with the TikTok app, they suggested, I read their letter at least, as suggesting that TikTok should reconsider, or Apple and Google should reconsider having TikTok in their app stores.
And what about the argument that we're not yet clear on what, if anything, China or some of the Chinese workers are actually doing with this data? How do you overcome that argument in trying to get some of these companies to get this off their app store?
Well, we do know one thing that's going on. There was a report from Forbes about 2 weeks ago that had Beijing-based ByteDance TikTok officials using TikTok to surveil persons in the U.S. that were not TikTok officials. So that's very concerning. We also saw the report in the lead-in segment here from 60 Minutes that talked about The version of the app that ByteDance makes available in China is educational. It shows museum videos, scientific experience. In the U.S., TikTok is showing to 10-year-old girls blackout challenge videos in which they've been encouraged to suffocate themselves, and in some cases have died as a result of that. So I think that's deeply concerning in terms of both the data flowing back to China, the surveillance opportunities, as well as the foreign influence campaign from the content that's being sent back to U.S. users.
Certainly an interesting issue FCC Commissioner Brendan Carr bringing up there. Now, it's important to point out that the FCC doesn't have the authority to regulate TikTok, but certainly the views of Carr has been shared with a number of policymakers on Capitol Hill. We know the House today at least pushing through the ban on TikTok on House devices, on government-issued devices there for House members and for their staff members. That, of course, does not apply to the Senate. But, Jared, you could take a look at this as it is a step forward of what many on both sides of the aisle, many lawmakers on both sides of the aisle have been calling for, and that is the ban on TikTok, a lot of that tied to the national security concerns.
Look, TikTok is too good for its own good. There's a reason why its AI tech is so much better than everybody else's, because it's able to get around, flout, I would say, not the letter of the law or the letter of the app store I guess, regulations from Google and Apple, but they violate the spirit of it. They bring in all of their own bloatware that's native to their own application. They don't use the Android libraries. They don't use the Apple libraries. It would be very easy for Apple and or Google just to shut this down, but there's too much money, in my opinion, involved. And this is a national security issue. Okay, well, then let's get moving. But it doesn't seem to be. As usual, it seems to be once you get to a certain size, you're too big to fail. So that's my quick take here. By the way, I don't work for the government. I'm not on TikTok, so I'm kind of talking my own book in an easy way.
You're not wasting a lot of time on it. But of course, though, a lot of users are going to be very upset if, in fact, we do see any sort of demand. And according to estimates out there, it's estimated 130 million U.S. users for TikTok right now. So if we do see a ban, many people will likely be very upset by that. All right, well, coming up, President Biden facing a new challenge in 2023, a divided government. A former U.S. Senator telling us how difficult it will be to make headway on his agenda next.
2022 brought us a lot of major headlines, from sky-high prices to a war in Europe and collapses in the crypto market as well. Here to break down some of these major stories is Yahoo Finance contributor Kevin Cirilli. Kevin, what's your biggest story of the year here?
I think we're going to have to go with inflation. I think that there's no way to look at it, but inflation, which currently hovers at about 7.1% compared to this time last year, according to the Consumer Price Index, was the dominant story, and it touched on everything from politics, where we saw it have a reverse effect than many pollsters thought in the midterm elections, where Republicans underperformed, but also to policy. The Inflation Reduction Act, signed into law by President Biden over the summer, was a very partisan issue. A hefty price tag, mind you, and Democrats on board for it. Now, the biggest question that I have when I look into the future with inflation is whether or not Republicans, when they take control of the House of Representatives, will try to peel back some of that Inflation Reduction Act. It also, we should know, touched on the Federal Reserve and interest rates. Fed Chair Jay Powell continuing to raise interest rates. And that garnered some criticism from progressives like Senator Elizabeth Warren from Massachusetts, who have asked openly whether or not those interest rates are going to tip the economy into a recession. But inflation was the center of all of the debate on the economic front here in D.C., as well as Wall Street and elsewhere.
And Kevin, another massive story, obviously on a global scale, Russia's invasion of Ukraine. Of course, the U.S. role in this, whether or not or how much we should be providing in terms of support and towards of aid, that of course is still being debated on Capitol Hill. Your takeaway just from the headlines that we've seen this year?
As we look forward, the biggest economic impact from Russia's egregious war with the Ukraine has been its impact on energy markets. And just in the last couple of days, Vladimir Putin saying that any nation who complies with the West's price cap on $60 per barrel for seaborne oil coming from Russia will not be able to receive Russian energy. That has really laid bare just how reliant the world, particularly Europe, parts of Europe in particular, are on energy from Russia. The crippling sanctions that were imposed against Russia have really put Vladimir Putin in a tough spot economically, and Russians in a tough spot economically. But from a policy standpoint, a broader takeaway from this conflict is that Americans of all political stripes still understand the value of an allied response and support for NATO. And the polls suggest that Americans value NATO. The polls also suggest that Russians are growing increasingly skeptical of Vladimir Putin and his long-term plan, and whether or not he has one, as a result of his invasion of Ukraine.
Kevin, also on the didn't see this coming list, crypto and FTX. Got to talk that before we go. Collapse of FTX happened toward the end of this year. Why do you still think it's one of the biggest stories of 2022?
Well, when we look forward into 2023, what does this mean for Securities and Exchange Commission Chair Gary Gensler, who's facing a lot of scrutiny from progressives as to whether or not they took their eye off the ball and let the cryptocurrency debacle happen? Secondly, he says he didn't, and he told Yahoo that he didn't. Secondly, as it relates to Americans who have digital assets, who are invested in cryptocurrency, many of them now wondering what this means for their tax returns. The Biden administration just announcing in the last week that Americans will not have to disclose on their 1099s, as was initially a part of the Inflation Reduction Act, their digital holdings. They've delayed that. So if you do have those digital holdings, you want to check that out with your tax accountant, because that has been delayed for this tax season. And then thirdly, will this finally force compromise between Republicans and Democrats? That margin and the balance of power is incredibly narrow. Will they come together to finally get the rules of the road? Kirsten Gillibrand, as well as others, working on some type of bipartisan path forward for who has the policy turf on regulating digital assets and cryptocurrency.
Certainly a number of huge stories that happened in 2022. It's going to continue into the new year. Kevin Cirilli, always great to have you. Thanks so much for joining us here this afternoon. Well, a number of new laws are set to go into effect on January 1st as big pieces from President Biden's agenda are implemented. That includes changes to the tax code for corporations, drug pricing, and the biggest attempt ever to turn the tide on climate change. Joining us now is former Senator Byron Dorgan, also senior fellow at the Bipartisan Policy Center. Senator, it's great to have you here on Yahoo Finance. There's certainly a number of changes on the horizon. Let's start with the new tax credits for clean energy. It's certainly a priority for the Biden administration. I guess, how will it work, and do you expect Americans to take full advantage of them?
Well, they have a lot of tax credits that were passed with the legislation, the Inflation Reduction Act, and those credits dealing with electric vehicles, energy, healthcare, they're very significant. You know, for example, some of them start immediately. The $7,500 tax credit for electric vehicles, some credits for battery technology and capability. And I also say, with respect to the homes, tax credits will begin immediately if you're going to buy solar panels, if you're going to put new windows in your home, if you're going to purchase heat pumps. You know, there's a whole series of things. If you're going to put a charging station for an electric vehicle in your garage, those are the kinds of tax credits that will start almost immediately.
And Senator, 2022 was a year marked by a number of big Supreme Court decisions. Just wondering what might be coming down the pike in 2023.
Oh, I wish I knew. I mean, this court is so far off to the right. And the issue, I think abortion will remain a very significant issue. But there are other big issues coming from this Supreme Court, and we'll have to wait and see. You know, there are also significant healthcare changes. Finally, at long last, the Congress in the Inflation Reduction Act took aim at the issue of the price of insulin. But this only applies to Medicare recipients, but they've said the price of insulin, you won't have to pay more than $35 a month, but that's only for Medicare recipients. All the rest of the folks will still be paying a great deal of money for insulin, and they should not be paying that kind of money. So there's a lot of things that in healthcare also that are going to be changed, and there will be caps with respect to the costs for prescription drugs for citizens on Medicare. But we need to take a better approach on the issue of drug costs generally. Brand name prescription drugs cost far too much in this country.
And drug pricing, certainly an issue that has support from both sides of the aisle. Senator, what about the corporate tax changes, a new 15% minimum corporate tax here? What do you think of this new rate, and I guess the impact that you see it having on U.S. competitiveness and also just on companies here in the U.S.?
Frankly, I don't think it's going to be a problem for competitiveness. I think the tax cut that was passed about 2-3 years ago that reduced it to 21%, I think that was too significant. But so I don't think it's going to reduce our competitiveness. But the 15%, you know, it'll take a while. That's with respect to those companies, only those companies that have $1 billion in income, and that deals with the book value. So there's also, by the way, a new excise tax that begins immediately on stock buybacks, a 1% excise tax on companies that start buying back their own stock. So there are a couple of things like that I think, you know, corporations will say that there's a significant problem with them. I don't think there's a significant problem, honestly. And I think there does need to be some sort of corporate minimum tax, because we've seen a lot of companies make a great deal of money and pay zero in taxes.
Well, we've also seen a lot of pain this year, not only for individuals, but also corporations. Just wondering if there's any kind of relief on the horizon for next year, maybe some inkling of something that might be coming down the pike.
You mean a tax policy?
It could be tax policy, anything stimulative in nature, whether that could be tax policy or direct investment.
Well, I think you know the issue of inflation is very significant, and I think the Fed, obviously, you know, their desire is stable prices and full employment. I mean, those are the two goals of the Federal Reserve Board. They're going to be doing all they can. They don't have a lot of tools, honestly, other than interest rates, and they're going to do all they can to deal with inflation. But look, both political parties have to start dealing with immigration. You just have to start dealing with immigration somehow. And I hope they do it in a way that allows the two parties or pushes the two parties to work together. Even when they vastly disagree on what the result might be, Everyone understands what the problem is. And, compromise is the lubrication here. The lubrication of democracy, when people feel very differently about something, even though they all feel that there's a significant problem, you need to compromise. And I think it's important for Republicans and Democrats to start caring a whole lot more about the country than their political parties. And there needs to be this lubrication called compromise in order to make democracy work.
And Senator, speaking from your several years that you spent on Capitol Hill, I think many Americans would like to see compromise from both sides of the aisle. Some of the issues, though, that you think Democrats and Republicans might be able to agree upon, any one or two things that you think we could see advance through both the Senate and the House?
Well, I think both political parties understand the urgency of dealing with inflation and want to find a way to deal with inflation. So my hope is that you'll have some support for that. Obviously, the war in Ukraine remains a significant issue. I think most Republicans and most Democrats feel very strongly that we need to continue to be involved in helping the Ukraine. So those will be some of the areas. But, spending as well. We have a $31 trillion debt. And both political parties need to understand that's a pretty serious problem. And we need to begin dealing with the spending issues in a significant way.
Senator, we got time for one more, so I'll just give you the floor here. Anything we didn't cover that you'd like to discuss or make a point about?
Well, the issues that exist, for example, with China, just to use an example, you move along and something happens and it's a new issue. The issue of baby formula shortage, right? I mean, who would have thought? And so these things happen. But the issue of China, I think especially, is going to remain a very significant issue for the United States. We watch Xi Jinping, who now apparently is the leader for life in China. We've got lots of issues with him. And I hope we can find a way to continue to begin working with China in a thoughtful way. And so we'll have to wait and see. But I think it will have a profound impact on our country, on China. And we also have to, at the same time, be very, very concerned about what Mr. Putin is trying to do in Russia. And as a result, we need to continue to provide support with Western Europe and others for the Ukraine.
Yeah, certainly a massive issue. And Senator, before we do let you go, the Supreme Court is also going to be focused on President Biden's revival here of what he's looking to do for student loan forgiveness plan. I'm curious just to get your thoughts on his plan and what you think should be done when it comes to student loan forgiveness.
Well, I wasn't a big fan of the plan the president announced. I'm a Democrat, but I think that the best way to deal with student loans is to reduce interest rates, number one, and number two, to put some pressure and some backbone in colleges to say, you can't keep doing what you're doing with respect to these costs. You're ratcheting up costs in dramatic ways that are terribly unfair. So I think that's what we should have done. I'm not a big fan of wholesale abandonment of the obligations that exist with student loans. But I would like to see interest rate reductions that are very substantial for them.
It looks like 2023 going to be a year critical for interest rate policy. Thank you for that, former Senator Byron Dorgan.
Thank you very much.
The estate from Glass Onion is up for sale, sort of. We're going to see Zillow has a listing. And for this compound, how much is it worth? We're going to find out when we get back. Avatar: The Way of Water, officially crossing $1 billion at the global box office. The Avatar sequel crossed the $1 billion benchmark after just 14 days, becoming the fastest release to cross that threshold this year. According to Disney, the film has passed Jurassic World Dominion to become the #2 release of 2022 and the #3 release of the pandemic era.
All right, Zillow and Netflix are giving us a peek into the lavish home depicted in the Knives Out sequel Glass Onion that came out on the streaming service over the holiday weekend. If you've seen the movie, then you're going to be excited about this. Now, this home listed for $450 million is 29,000 square feet, 17 bedrooms, 22 bathrooms. Features include an ocean view, private beach, 6 pools, priceless works of art, green energy power, museum grade security. Certainly a smart promotional move here, marketing move from not only Zillow, but also clearly Netflix here, drumming up some excitement around this movie, Jared. I haven't seen it yet. Have you?
You haven't? I saw it. I watched it over the weekend. I did not see the first one, and I was a little bit disappointed. I didn't see what it was all about. I did like the house. I wouldn't mind living there, and especially if it contains priceless works of art, because if you can't put a price on it, that tells me it's worth more than $450 million. I don't know. That's my take.
It certainly has been a hit. 82 million viewing hours have happened so far. 35 million households have watched the movie. This is according to Netflix. Even with those impressive numbers, though, it only puts it at #6 in terms of the biggest debuts for Netflix. So we'll see. I have to see it. I don't know. I've heard good things, though. You're the first person. Yeah, we'll reconvene after I watch it. All right, well, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. We'll see you then.